Okay, let me share my screen. Do that one. Okay. Okay, this is a PowerPoint presentation prepared by my favorite analyst. His name is Barry Habib. He runs something called MBS Highway. He's been named Economist of the Year multiple times. None of us have a crystal ball, but this guy is so good so often, so right so often. They actually have created an award called the Crystal Ball Award, and he wins it all the time. So this was the outlook as of February of 2021, projecting into the future. I'm going to go through this because a lot of these things happened and there's a lot of fantastic data in here. And then I'll also go to the 2022 forecast that also just came out. Okay, so this slide is really just talking about Janet Yellen is becoming Secretary of the Treasury. She wasn't awesome when she was in the Fed, but it is what it is. This is a great chart that shows that the Federal Reserve does not set mortgage rates. What they set is the federal funds rate. And the federal funds rate is the rate at which banks lend money to each other overnight. A good analogy I like to use is if I'm the bank of Joey and you're the bank of Franny, at the end of every single business day, our books have to balance. Our assets have to equal our liabilities. And if I brought in $2 million worth of deposits and made 1.5 million in loans, I had 2 million coming in, 1.5 going out, I'm a $500,000 heavy. If the Bank of Franny had the opposite situation where you brought in 1.5 and made 2 million going out, you've got $500,000 too much going out and your books don't balance. I would lend you my $500,000 overnight, so your books would balance and my books would balance. The rate at which I'm charging you interest for that overnight loan is the federal funds rate. And it's been at zero for a very long time. And this chart is really showing kind of the orangish red is the federal funds rate, and the blue is actual mortgage rates. And while they do tend to move similarly in similar patterns, they're not in lockstep. So this chart is showing when the Fed funds rate was zero here between 2010 and 2012, interest rates jumped over 1%. Same thing happened here. Again, the federal funds rate is just creeping along the floor here at zero. It jumped 1.25%. Rates jumped when nothing was happening with the Fed funds rate. So this is just a really good indicator that despite what the media tells you, the Fed does not set mortgage rates. Their monetary policy can change what mortgage rates are doing, but it is not the primary driver of what mortgage rates are doing. This is showing as the country's debt increases, interest rates decline. This is the United States. It's a very sad chart, but it's a good chart for mortgages. Debt in the United States is through the roof. Mortgage rates are down. This is France, Japan, Italy, and the UK. Exact similar correlation. Higher debt, lower rates. So as a country, we're going to see rates low for a long time. In fact, there has been speculation that we will never see rates above 5.5% ever again in our lifetimes. Right now, this is a side topic, but last week they released the inflation figures, and we're at about 7.5%. That is the highest rate since 1982. In 1982, mortgage rates were 15 to 18%. So as we are approaching this rising rate environment, rates are going up. We're in the 4s, pushing 5s almost. That's not a big deal. We're not at 18. You know, my first mortgage was at 6.5, and I was like, cool, that's what car loans are at. You know, that's the interest rate on car loans. That's normal. And it's good for the economy to have higher rates. Okay, so this is talking about rates to stay low, but inflation, you've got other things that happened after COVID, the supply chain issues, all this stuff. These are just kind of building up, and this is right, rates likely to bump before going downtrend. This chart is a fantastic chart because we study the data on everything in housing. So for example, in the early 70s, abortion was legalized. Well, 33 years later, the average age of a first-time home buyer, home prices, or not home prices, there were less buyers in the market because there were less humans on the planet because of abortion. So what we're looking at here is the first-time home buyers today were born in this time frame. And as you look to the right of this chart, there will never be a time in the foreseeable future where we have less first-time homebuyers entering the market than we do today. There's going to be incredible demand in the market, incredible demand. And then you add this to it. COVID shut down. When COVID hit, builders couldn't build. Nobody could do anything. That exacerbates the problem because they're not putting more inventory on the market. You've got strong demand, limited inventory, builders were trying their best to put more inventory in the market, but haven't been able to during this time because of COVID. Now, this chart speaks to vacancies. So if you are a landlord and you have a rental house and people are knocking down your door to rent your house, in fact, they're offering more than you are asking for rent. I have a client in Hawaii right now who's like, I was going to rent my house for $2,500. I had somebody offer me $3,300 because rents are rising so crazy. There's no vacancies. So these owners of these properties have no incentive to sell these houses and add inventory to the market. Again, lots of demand, minimal inventory. This chart shows inventory, and the most important thing is at the top right here in 07, 08, there are about 3.2 million homes for sale in the United States. Now we are down here. There's about 900,000. This is from 2020, so we're even lower now. There's about 900,000 houses for sale in the United States across the board, and we have 12 million more people than we did at the height right here. So all of these factors are showing massive appreciation in housing, and not a bubble. Not a bubble. It's a great time to buy. Rates will stay low. There's going to be great appreciation. This forecast said 6% on average. We hit 18% last year. So this is very conservative. And then this chart is something that I gleaned from a Harvard article, How to Use Real Estate Trends to Predict the Next Housing Bubble. And it talks about how real estate is cyclical. For the most part, with just two exceptions, World War II and the mid-cycle peak created by the Fed doubling rates in 1979, basically every 18 years, real estate values peak. So if we're talking 2008 was a peak, we're probably looking 2024 before we hit another peak. Now, right now we're in phase 2, which is expansion. We have a ton of construction going on. They can't build fast enough. Builders, although they try to keep their finger on the pulse, they aren't super awesome at doing so. And so they ultimately, inevitably, will have built too many houses, and we'll have hyper supply, phase 3 here. When we have hyper supply, it probably, in my opinion, will coincide with the 2024 equalization peak, in that, okay, we've built, and we have now met the demand of housing in the United States. In fact, we have too many houses. So instead of us seeing 18% year-over-year appreciation when we get into phase 3, I think, and the analysts think, we'll probably slow down to 1 to 3%. So it's just like if you're going 65 miles an hour down the highway and you slow down to 55, you're still moving forward. Your house will still be gaining value. It will not be as aggressive as it is right now, but it will still be gaining value.
Hey, Joey, can I ask a question here on this?
Absolutely.
So I have a client who is looking to do a custom build. Well, I have two clients actually, and it's gone from the build time from 6 months, 6 to 8 months is what it's been in the past, to over a year now. And the prices are jacked up over there too. And obviously the reason for the build time, well, there's many reasons, but it's mostly supply chain is down. Getting lumber, getting cabinets, getting all that is just taking forever. Do you think that's going to change this kind of projection any? Do you know what I mean? Like, so the projection we're going to build, the builder's going to build, but they can't build like they used to be able to, like in these times when we need the houses, the builders will build. But I just see it's really a bottleneck right now.
That's an excellent question. And I think you're absolutely correct. It absolutely will affect this. It's tough to say. Before our call, I was on the phone with a major developer in the Southeast United States, and they think next year is going to be the year of gangbusters, just massive construction. Maybe these supply chains will be alleviated, or the supply chain issues will be alleviated at that point, and they're just going to, make hay while the sun is shining. If they have now access to be able to get lumber, to have workers, they may do double time. They may hire more. I can't speculate on that, but that's a very realistic statement. Maybe it's 2026 that we see things equalize because of this. We don't know.
Yeah.
Mm-hmm. We're in times that we've never seen before, just like World War II and the mid-cycle peak when the Fed doubled rates.
Right.
We'll see what happens.
Yeah.
That's a good question, though.
Yeah.
Okay, so that is that one. I'm going to open this next one here. we go. Share screen. Here we go. Okay, so this is the 2022 market forecast. This one's more talking about, I don't want that there. I want this over here. Hold on. Okay, can you see it still? All right, scratch that. I know it's trying to open it on different screens here. Sorry about that. Okay, can you see the market forecast 2022?
Yes.
Okay, every time I try to make it in presentation mode, it puts it up on my other two monitors, so I'm not going to do that. So we'll just stick with this. I don't know why it's doing that. So this one speaks more to what the Fed's going to do, what the Fed has done, and how they can manipulate the markets. So this is a recap of 21. Expect rates to rise beginning of the year and recover in the fall. We're seeing that right now. We are in a rising rate environment right now. The Fed is going to jump in and they're going to do what they can do. They have a lot of tools in their tool belt. They can raise the federal funds rate. They can let their balance sheet run off. Basically, when COVID happened, the rates went nuts. Like overnight rates jumped 2%. Never seen it before or since. But the Fed jumped in and they started buying mortgage-backed securities, or MBSs, which are your mortgage, my mortgage, the neighbor's mortgage. They get packaged and securitized and traded in the secondary market in the form of bonds, specifically mortgage-backed securities, or MBSs. And when the Fed jumped in and started doing that, it kept rates low. They call it quantitative easing. Quantitative easing. Now they're talking about doing quantitative tightening, which includes letting their balance sheet run off, not buy as many mortgage-backed securities. The ones that expire, not buying new ones. That will cause rates to go up. Okay. Housing forecast, strong demand and tight supply. It's going to happen again. We're looking at they're saying high single-digit percentage in this. I was on a call with one of the chief economists with CoreLogic yesterday, and he's looking at double-digit again this year. So your house will be worth 10+% more than what you bought it for this year, just because supply and demand. Everything in economics is supply and demand. And again, supply chain issues, labor shortages, all the things. Okay. All right. And the Fed's really going to make a major role in 2022 because, again, they're talking about tapering, rate hikes, balance sheet runoff. Interestingly enough, when the Fed raises the Fed funds rate, it will make mortgage rates go down. Because when they raise the Fed funds rate, it combats inflation. With our super high inflation right now, we need that to happen. It will bring rates down because those mortgage-backed securities I was talking about, investors buy those. Your 401k has MBSs in it. And if this MBS is earning 3%, but your money's losing value at 7% per year, why would you do that? Inflation is the arch enemy of mortgage-backed securities, mortgage bonds, and therefore rates. So when the Fed hikes the Fed funds rate, it will help to stave off inflation and bring interest rates lower. What will not bring interest rates lower is balance sheet runoff and tapering, letting things expire and actively selling the mortgage-backed securities they have on their books. That will cause rates to go up in the short term. We're thinking mid-year probably will hit the peak, and then we'll probably see it start to come down. Okay, fighting inflation is the main focus. They should have hiked sooner. This should have happened at the end of last year. They thought it was transitory. They used that word like it was going out of style, transitory. But now the market is acting as it should. Rates should be going up, and it is good. Hard as that is for me to say as a mortgage professional because I live on rates. All right, this is a history of previous Fed chairs. Arthur Burns in the 70s, he was the Fed chair. He ignored inflation, had massive rising, called it transitory. Again, sound familiar? They went from 7% to 14% in the 2 years he was there. That's insane. And he just basically was like, nah, it's not a thing. We're not doing it. And that's when rates went from 12 to 18%. Paul Volcker, he said, okay, I see what happened there, and I see what's happening here. He hiked the Fed funds rate from 11 to 20% in 2 years, which dropped inflation extremely. Just like we've been talking about, hiking the Fed funds rate helps stave off inflation, which helps mortgage rates. They went from 18 to 12%. If you had an 18% rate and you're refinancing at 12%, you are a happy camper.
Hey, Joey, can I? Can I ask a question about that? Do you feel like this adjusting adjusting the rates or whatever they're doing to bring down inflation, which then in turn brings up the mortgage rates sometimes, right? Do you feel like I'm always concerned about the little guy and affordable housing and does that, like, bringing down inflation but bringing up mortgage rates, does that help or hurt the little guy? I'm going to mute here.
Sure. So bringing down inflation actually brings down mortgage rates too. But these other things that they're doing, like the balance sheet runoff and the tapering, that will make rates go higher. And you are 1000% correct. The first-time home buyer is in a very difficult situation right now because you've got these inflated home prices due to appreciation because of supply and demand and the normal market actions. And then if rates go up, you know, I have buyers who are pre-approved in November, say at 250. Well, rates went up 1.5%. You know, they're at 175 now to qualify, and there's no houses available in their market. And the tough thing for them is rent rates are going up as aggressively. So they don't have to qualify for a mortgage to get a rental. So they're going to end up having to rent. And what we're thinking is next year we'll see a mini recession because everything is overpriced in the economy. The stocks are super high. There's too much money pumped into the economy because of COVID and all the stimulus stuff. We're due for a correction. That will bring rates down. I hope that brings some relief to first-time home buyers, but it's not going to slow the rate of appreciation of real estate. They're still going to have to, maybe they can't buy for 250 in this illustration. Maybe they got to go into 225, but the rates going down will help them. Okay, so consequences to doing these things. You know, we hear the Fed and they're going to have their minutes and everything. We kind of wonder, what are you doing behind the scenes? All the stuff they're doing, they have calculated and they're taking calculated risks. But there are also consequences. You know, you hike the Fed funds rate almost double. Well, the stock market crashes, 30% drop. Recession in 1982. It is what it is. I mean, you can't pull one string without the other part of the whole marionette doll being affected, you know. And then Alan Greenspan, he was in the late 90s. Inflation doubled from 1.75 to 3.5, caused rates to jump 1.5%. Unlike Burns, Greenspan took action in mid-1999, hiked the Fed funds rate by 1.75, matching the raise in inflation from 4.75 to 6.5. Inflation responded and dropped. It works. We've done it before. We're doing it again. Rates dropped as well. Huge refi boom. That's going to be next year, maybe 2024, but we're thinking next year. So on this note, I want to say something quick about discount points. A lot of internet lenders especially will quote the lowest rate absolutely possible. And you can do that via discount points. This is a different conversation about something else, but it's important because when you Google mortgage rates, you will see rates in the twos, and those are absolutely available. But a discount point, or discount points plural, is where you bring extra money to the closing table to buy down your interest rate. You don't have to do it, but you can do it. But if you do it, you have to do a calculation called a recuperation period, recuperation cost analysis rather. If you're going to spend $5,000 extra at closing in points, and it's only going to save you $50 a month in payment, 5,000 divided by 50 is 100 months. That's 8.33 years. You need to make 101 payments before you've paid yourself back that $5,000 via monthly savings to recuperate the cost of points. And if we're looking at things and we're being realistic about what's going on in the economy, why would you do that if I'm going to be calling you in 12 to 18 months to refinance at a 1% lower rate? You will not have recuperated those costs. Okay, so that's why it's so important to pay attention to these things. Any Joe can become a loan officer and get their license and say, oh yeah, here's today's rate. But there's so much more to it. Your mortgage is not just about your rate. Your mortgage is about financial planning. And this is the kind of stuff that we look at. All right, Jay Powell, Mr. Jerome Powell. Okay. Again, he thought it was transitory, the inflation, rates jumped. They're currently tapering their purchases of mortgage bonds and securities or in treasuries. They say they're not going to hike and reduce purchases at the same time, but there's a Fed chair named James Bullard who is very bullish, and he's saying, oh, we're going to hike the heck out of this, and we're going to sell all of our mortgage-backed securities. Like, he's out there talking crazy. Not everyone agrees with him, so I don't think that's going to come to fruition, but we're definitely going to see 3 or 4 hikes this year. maybe more next year. Inflation and interest rates can still rise until Fed acts. If the Fed can tame inflation, mortgage rates should drop, but maybe from higher levels. So again, hopefully next year we see lower rates, maybe as soon as the end of this year. Okay, so this is just kind of a recap here showing Burns and Volcker, inflation doubled, Greenspan, inflation went up, Powell, inflation went up, where were rates at the time? And I'm going to leave this on there for a second, just so everybody can see it. Kind of what happened, where the Fed funds rate was. It's a lot of data, but recession shows up in every single one of these. It's kind of inevitable. It's a market cycle. Okay. COVID obviously changes things. If we have another variant or another outbreak, it could change everything. COVID could change everything. That's just the statement of the century. Stimulus may fan flames of inflation. If the government comes out and says, okay, we're doing it Oprah style again, everybody's getting dollar bills, y'all, we're going to see more inflation. And that's going to make the Fed have to do whatever they have to do. So right now, the Fed is going to stop purchasing new mortgage-backed securities, MBSs, and treasuries. Then they're going to hike the Fed funds rate next month. It's coming, inevitable. I don't know if they're going to do 25 basis points or 50, but it's coming. They're still buying $70 billion a month in mortgage bonds through reinvestment. So those loans that pay off, they're rebuying new loans and keeping their balance sheet pretty flat. But if they start letting it really run off and not reinvesting, it's going to cause rates to go up. This, when I was referring to everything being expensive right now, this is looking at the median price to earnings, price to gap earnings. Like, this is stuff that I don't really get into. I'm not an asset manager, but basically everything is incredibly overvalued in the stock market. We're due for a correction. This is showing most recent value. Let's see if it has historical. Okay, it's just forecast 10% decline in the major indices in 2022. So we're due for a stock market correction. I'll just leave this here for a second so everybody can take a peek at it, do a screenshot. Okay, so again, rates are going to go up this year until they're not going up. None of us have a crystal ball, but this is interesting because rates are really about 4.25 right now. So we're already above that. And as the Fed hikes rates, it should bring rates down in the second half. But if they do that tapering and balance sheet runoff, it will counteract their Fed rate hikes. And this is where I was talking about. This sets a bias for less upfront fees because of refinance opportunity ahead. Do not pay points. Do not pay single premium mortgage insurance, because I'll be calling you in 18 months max and we'll be refinancing you, and there's no reason to do so. Hell, you could potentially just do a lender credit. Just like you can buy down your rate with discount points, you can get a lender credit. Have you ever heard of those car dealerships that offer 0% financing or $5,000 cash rebate? Well, if you go to the dealership and you choose the 0% financing option, you don't get the cash rebate. If you choose the cash rebate, you don't get 0% financing. Your rate's 4.9% or something similar. And that's not inherently bad. That's just how rates work. If you want a lower rate, you bring more money to the closing table. You want to get a credit or a rebate, you take a higher interest rate. So it would not be unwise, if doing a mortgage transaction right now, to say, cool, stick me at 5.5% and pay all my closing costs, because just like we calculate the recuperation period when someone pays points, we also calculate the recuperation period if you receive a lender credit. And most of the scenarios that I've run recently, it's 4 and 5 years out. So as long as you refinance before that 4 and 5 years recuperation time frame, you beat the system. You made more money off of this transaction than you paid by having a higher interest rate. So yeah, lender credits are a great idea right now. Don't pay points. Don't do single premium mortgage insurance. I don't know about this statement here, especially in light of that Core Logic video, which I shared on my Facebook page, by the way. It's an hour long. It's long in data, boring stuff, but as a nerd, I love it. If you want to check it out, it's fantastic. Okay, rent's
so
going
are you
up.
saying that's maybe saying that we're not going to be as strong?
I think it's going to be as strong as last year. I do. I mean, I was talking to a broker.
I would agree with that, by the way. Just on the boots on the ground kind of thing. I just It's just, there's just no houses.
Yeah,
I
exactly.
mean,
And
I
it's
don't know
simple supply
how
demand.
else, I don't know how else you compute that any differently.
Mhm.
It's just going to push those prices up.
It's like if the new iPhone came out and there was a super limited supply, they only made 1,000. Well, people would be willing to pay more than the 1,000 or 1,200 they're used to. Maybe I'll pay $3,500 for this iPhone. I need it. I want it. I have to have the iPhone. It's the same with housing. You need a roof over your head. Rents are going to be going up at the same, or are going up at the same
Right.
rate as house prices, supply and demand.
So I have to tell you a side stat too. I don't know exactly the number, but we are seeing, even though there's low inventory, um, we are still selling a lot of houses, at least in Kansas City. And why I'm saying that is, so if we have low inventory, but we're still selling a lot of houses, we have more inventory than our MLS is saying we have. And which is where the data comes from. Like, that's usually when these kind of reports are being discussed, it's like it's MLS data. And so, but the irony of off-market houses being sold is what that is that NAR has been cracking down hard on pocket listings. Like, we are not supposed to sell a house. They just are discouraging by fining us if we don't bring the house to the open market. I mean, you can do it, but really? And with Betty, weren't we? Betty Ray, come here.
Wants to be part of the conversation. So with that, I want to bring another statistic up. On that video that I'm referring to, that hour-long one, they said last year 1 out of every 6 buyers was an investor. And these investors are looking at it like, I don't really care if I rent this thing or not, because the appreciation is so strong. I'm going to buy it this year and sell it next year. So hopefully that starts to help alleviate some of the supply issues. You seeing the same?
Would you take
You're
her
still on mute,
outside?
Grant.
I'm on a Zoom with Joey. We're recording. I wanted to do this in the office today, so for this exact reason, or take Betty Ray to daycare, and neither of those were happening today because of the snow.
One last thing I would like to share with y'all. Okay, so this is a lot of information. It's not meant to be all inclusive, but it's going to speak to a little bit of what I was talking about. This is what when we're talking about mortgage-backed securities, this is what it is right here. This could be a $100 trillion bond or mortgage-backed security. It's earning the investor 3%. If the stock market is doing really well on a given day, they're going to move the money out of the bond market and put it into the stock market, because they're trying to make you a better than 3% rate of return, because that's what you hired them to do. They're your asset managers. If the stock market takes a plunge, if Russia and Ukraine do some stupid stuff, those investors will move the money out of more aggressive monies or monetary vehicles into more conservative monetary vehicles like the bond market, which is what's happening today. So right now we're up 34 basis points. 34 basis points is 0.34 discount points. So if you see an internet advertisement that says, well, this costs 2.5 discount points, that's 250 basis points. And that can be seen in the charts here. This is what happened on COVID. So this day we were having a good day. Everything was fine. March 2020, we went from a price of 103 for this bond to 99. So we lost 300 basis points in a matter of days. That's what happened with COVID. And you can see here where the Fed jumped in and started buying mortgage-backed securities, doing their quantitative easing, and things leveled out. We can look over COVID. Fed jumped in, everything was a whole lot cooler. Well, here's where we are now. Bond prices have started sinking since January 3rd when the markets opened, right here. and have done nothing but go up since. And when we look at this stuff, none of us have a crystal ball, like I've said, but what we do have are the technicals. And it's really kind of cool. I've gone through some advanced training, Advanced Schools of Banking 1 and 2, Principles of Commercial Lending, Certified Mortgage Advisor training. And these horizontal lines are called Fibonacci retracement levels. They act as floors of support or ceilings of resistance. Floors of support if we're trading above them, and ceilings of resistance if we're trading below them. This is the 25, 50, 100, and 200 day moving average. So those are averages of previous performance of this bond, and it's supply and demand. So everything is supply and demand in economics. When we're talking about money moving back and forth here, if there's a lot of demand on the bond because there's a stock sell-off or global uncertainty, it drives the bond price higher, supply and demand. Same is true on the flip side. If there's a sell-off in the stock market, if everybody's jumping to stocks and there's a sell-off in the bond market, it drives the price of the bond lower. And that's why that's important is mortgage-backed security prices have an inverse relationship to mortgage rates. We want high bond prices because it means low mortgage rates. Right now, we have low bond prices and higher mortgage rates. But if we want to be honest, we're at about the same rates we were. I guess this chart doesn't show it, but we're at about the same rates we were in 2019. It's nothing scary. People still are buying houses. You still should buy a house. It's a great time to buy a house. Rates are still really low. You're borrowing money at a rate lower than your dollar is losing value by sitting in your savings account. Your dollar is losing 7%. You have $100 today. You go to the grocery store, you buy $100 worth of goods. This time next year, you take that same $100 and go to that same grocery store, you can only buy $93 worth of product. So why not borrow money? Why not buy a house? You're borrowing free money. Your house is gaining value at a crazy rate, and it's not going to be a bubble. The bubble that happened in 08 was because of horribly written mortgages. People literally only had to fog a mirror and you could get a mortgage. They called them ninja loans, N-I-N-J-A. No income, job, or assets. Here you go, have a house loan. They had negative amortization, or neg-am as we called them. I was not in the business at that time, so I didn't write any of this terrible paper, so don't blame me. I only do clean paper. But these neg-am loans, it could be like, hey, your monthly mortgage is supposed to be $2,000 a month, but you could do what's called pick-a-pay. You could pick your payment. If you're supposed to make a payment of $2,000 a month, you could say, I'm going to do $200 this month. Well, that adds to your loan balance. Your loan balance is going up when it should be going down. A full amortization is when your loan pays off by the end date. Well, these neg-am loans, the balances were going up. We also had ARMs, adjustable rate mortgages, which are not horrible inherently, but the ARMs that they had didn't have the restrictions we have now. So people literally would have their mortgage payment triple overnight, and they just couldn't make their payments. So they were like, deuces, I'm out. And they would just leave the house and be like, I can't make the payment, I'm out of here. That caused the last bubble. When there is an influx of inventory into the economy, this $500,000 house, an investor can come in and say, I'll give you $250,000, and the bank's like, cool, we're not in the business of owning homes. Get it off our books, we'll take the write-off. And that's what caused the last crash. We're not seeing that right now. We're writing the cleanest loans in history. Foreclosures at the lowest level ever. Serious delinquencies over 90 days are at the lowest levels ever. Minor delinquencies over 30 days are at the lowest levels ever. Everything is wonderful, despite what the media tells you.
Okay, I have a metaverse question for you.
The glasses are coming on. Okay.
Metaverse. So, what do you think? Is the metaverse going to cryptocurrencies? Are they going to cause any change in all these bankers and financiers? Is that going to change anything?
Couple things. I think that crypto is here to stay.
Yeah.
Crypto is being referred to as the new gold because it's finite. It's finite. When they stop mining crypto Bitcoin in 2050, they won't make any more of it. You'll just be able to buy portions of it. And I got a great, did I email you this video? I will send this, anybody that wants this video, I've got a fantastic video that tells the ins and outs about crypto. It's phenomenal. Again, it's by Barry Habib. Crypto here to stay, metaverse, I don't know. I mean, you watch sci-fi movies and people get into virtual reality and they live in different worlds. Yeah, I think we're getting to that. Would I spend money on digital land? Not right now, probably. But I also said no to crypto a couple of years ago. I was like, I'm gonna gamble a little bit, but now I'm all in on crypto, but it's got to be legitimate crypto. Don't buy the.
Well, the NFTs is where I'm like really looking at, like I see NFTs now, like Bitcoin was, 10 years ago. But I mean, geez, when I see some of the people like Gary Vaynerchuk is making millions of dollars off of NFTs, just little paintings that he sold, that he put up on the market, that went way up. But part of that was people want to, he's the famous tech guy, right? So people want to go see him present stuff. And so when you buy one of his NFT paintings, little animal paintings, you have access to go see Gary anytime he speaks. So as soon as people found that out, it's not about that. They started reselling it and the prices started to go up. Now, I don't know if you saw that Snoop Dogg is starting a music production company, all NFT based.
Didn't he buy Death Row?
Huh?
Yeah. I heard he bought Death Row Records.
Yeah, but he's going all in with NFT, with doing it NFT.
Wow.
So anyway, who knows? I mean, it's I mean, there's many things going on, but it's the equalization of capital that's happening, which I think is fun. But I don't understand it enough to know its effects and longevity and all that. I haven't bought any. I don't know. I think I had a few Bitcoins. Long story. I sold them or I cashed them out. But you still have some, right, Stacy? You're muted.
I'm messing around with it a little bit. I'm not really, I wouldn't call it investment. It's more like playing to see the trends and what's happening.
Yeah.
So
it just would be interesting to me to see the people who do. I mean, there are some believers in this stuff, like believers, people with money. And like, they're like, like one guy was talking about when Web 2.0 came about, and everybody's like, Web 2.0, what is that? And it's like, it's what we're living now with social media that totally changed everybody's world. And now he's saying Web 3.0 is that next, which is Metaverse and NFTs and cryptocurrencies is that next move. And I just don't know if, anybody in the higher ups of your feds in the banking and all that is really taking it serious or not. It's just interesting to me.
I'm gonna paste into the chat. I hope that conveys with the recording. Oops, don't play. Not what I wanted. Okay. This is a very awesome, informative video about crypto.
Okay.
And I'm going to paste one more now that I'm on a roll.
Sorry,
here.
I just wanted to pull it up. I'm back.
Yeah, and feel free to take over the screen share if you can.
No, I'm not going to. Okay. I'll look at it later.
Okay. Last thing I will add here. Here we go. This is a housing market hour-long seminar. It's boring unless you have lots of time and interest. Stop. Okay. But it's really cool stuff. It's like the chief economist with CoreLogic. CoreLogic is, let me read how I had to like write this down. CoreLogic is a.
Oops, sorry. YouTube's taking over.
Oh, that's what happened. That's what happened to me too. Yeah. So CoreLogic is America's largest provider of advanced property and ownership information analytics and data-enabled services. They basically value homes. And this guy's the chief economist. He's the chief economist at CoreLogic, and he's kind of fun. He's got a little bow tie and everything, but he's got some great data. You're on mute, Franny.
You should look at some Gary Vaynerchuk stuff. Like
I love Gary V.
He's the one who I went all in with when I started real estate. Like he was the person I was following, reading. I mean, this first book, Crush It, and I just think he's a genius. And so
He is
I'm trying to
incredibly
catch up to
vulgar,
it all.
but super smart.
What did you say?
Incredibly vulgar, but incredibly smart. I think he's inventing cuss words at this
people
point.
like about him. Yeah.
Yeah, he's real. He's real. That's one thing you can never say against him. Like, he's not going to blow smoke. He's real.
Mm-hmm. Yeah.
Mm-hmm.
Hey, can you stop the recording?
Yep.